Hi, this is Ron Cipcic. In this particular video, we're going to take a look at one of the myths of monopoly, and that is the idea that monopolies actually try to maximize price. In other words, they try to engage in price gouging. When you hear people talk about monopoly, they'll often bring this up, that monopolies are prone to charging the highest price possible. And when you look at that using monopoly modeling, you see that that can't be true. The modeling that I have before you is modeling that shows the monopoly in a profit maximizing position. Notice that we have a relatively steep demand curve. Remember, the monopoly is a firm that is selling a unique product, which means there really are no substitutes. And if that demand curve is, the market demand curve is steep, remember the monopoly faces the market demand curve, its MR curve will also be steep. Like any firm, the monopoly attempts to operate where marginal cost equals marginal revenue. So we find the point where marginal cost equals marginal revenue. We read down, we get the optimal quantity, Qmax. And then if we read up to the demand curve up here, we get Pmax. Notice that Pmax is not the maximum price, it's the profit maximizing price. Notice there's also many prices above Pmax. So the firm is not attempting to maximize price when it maximizes profits. It is trying to maximize what? It is trying to maximize its total profit. So this box here that I have shaded in is the maximum total profit box. And remember, let me just write this out nicely. Profit is price minus ATC times Q. Well, if we're at the optimal price and if we're at the optimal Q, then we have to be where? We have to be at the optimal, in this case, maximum total profit box. So total profit is maximized. Notice again that price is always taken off of the demand curve and ATC is always taken off of the ATC curve. So this is the average total cost at the profit maximizing price. Notice also that that is not the minimum of the average total cost curve. That point is at Qmax, and that's why we label it with a sub M. Okay? Now, let's suppose, for the sake of argument, that this firm tries to charge a price above Pmax. So let me pull up my ruler function here and move the production rate much lower. So let's go ahead and select a price which is well above Pmax and an output rate that is well below Qmax. So I'm identifying a production rate that is very low, and I'm identifying a price which is what? Which is relatively high. Okay, so let me get this thing level. Then I'm going to push it up here, and I'm going to, and this price, I'll just bring it over here. This price, which I'm going to call the maximum price, not the profit maximizing price, but the maximum, and it's not the maximum price. There are prices above that. So I don't like that. Let's get rid of that. Let's call this, just for the sake of argument, let's call this P high. And why is it high? It's above the profit maximizing price. Notice that that's going to cause the firm to produce at Q low. So what's the problem here? The firm is in fact charging a higher price than its profit maximizing price, and because it faces a downward sloping demand curve, it's going to sell less. Okay, so even though the demand curve is relatively steep, the increase in price, you'll notice that the increase in price causes what? Causes a decrease in the quantity. Okay, and if we calculate the maximum profit box again, let's bring that ruler back in here and find where ATC is at that quantity. We're going to see we got a problem. You go, what do you mean we got a problem? Well, we're going to see that the profit box is much smaller. You go, prove it. Well, let's shade this in. Put it back in there. And let's just keep shading this in. And you can see that the area of the box has shrunk. Even though the box is much wider, the box has a smaller area. And as a result of this, we're able to represent that the total profits actually dropped. The average profits increased. The distance between price and ATC has actually gotten much larger. You can see that the firm's margin has improved significantly, but because it's selling fewer units, its total profit has fallen actually significantly. So if you were to check out the area of this red box against the area of the black box, and we're not going to do that, but if we put numbers on here and these numbers were scaled, you'd see that what we've picked up here is we've picked up this area up here, but this area is actually quite a bit smaller than the area we've given up. So the total profit has actually fallen. So this idea that profit maximization is price maximization is a myth. The goal of the firm is not to maximize the price, but to maximize the profit. Now, if the firm were originally charging this price P high and producing at this level Q low, and recognize the fact, what would the firm actually do? Well, the firm would reduce its price. The firm would reduce its price, and in the process sell more and produce at Q max. So you go, no, the monopolies never lower the price, never lower their price, and that is not supported by theory. Monopolies do lower their price if it improves their total profits. So, you know, there's mythology. There's things that people believe, particularly people who haven't really studied the theory, who believe that, you know, because you're the only firm and you sell something that's unique, your incentive is to charge the highest price possible. And at the end of the day, that just doesn't hold water, because your goal isn't to maximize margin by maximizing price. Margin is that gap between price and ATC. Your goal isn't to maximize margin, your goal is to maximize total profit. Notice also that by maximizing price, you operate at an output rate that is even further away from maximizing revenue. So this is where you maximize your total revenue, where MR equals 0. And if you operate at this P high, you're even further away from revenue maximization. So your reward for charging the highest price possible, let's say way up here, I mean, run this in the extreme. If you charge the highest price possible, you sell how much? You sell one unit. Well, if you actually calculate the total revenue on 1 unit, I mean, charging the highest price possible and still selling a unit would be to charge the price that allows you to sell 1 unit. Well, if you sell 1 unit, whatever the price is, you're not going to generate a profit box anywhere near the red box, let alone the black box. So again, this is a very easy way. This modeling is a relatively straightforward way to see that the goal of the firm, the goal of the monopoly, is not to maximize price. Even though it has absolute price making ability, its goal is not to maximize price, its goal is to maximize total profit. All right, so enough said.